Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He has decades of experience as a credit analyst. He's financed many mines to go into production over the years. He's a former vice president at Sprott Inc. and a long and historic career in the natural resources industry. Rick Rule, thank you for joining me again.
Jason, it's always a pleasure to talk with you. I look forward to it.
So, Rick, we're recording this interview on Tuesday, March 28th, 2023. The spot gold price is above $1,950 at $1,973 an ounce. Silver is above $23 at $23.33 an ounce. I want to get your thoughts on profit margins for the gold and silver mining industry. Do you think the margins, especially for gold miners right now, are really robust?
I think on a trailing basis, they're robust. I think absent an increase in the gold price, they become less robust. Thus far, certainly through 2022, inflation in the costs around the gold industry outpaced increases in the gold price. Secondly, I would suggest to you, Jason, that expenses are understated in the sense that the gold industry has considered itself to be capital constrained. I would suggest to you that expenditures in exploration and development have not kept pace with the amount of gold being produced. And I would suggest that gold mining companies need to increase capital expenditures so that they have the ability to maintain production in the out years, which they have not been doing. I do believe that the set of circumstances is in place to cause an increase in the gold price that is more rapid than the increase in the gold price that we've seen in the immediate past. But at present, what you're seeing is that cost pressures, cost inflation in the gold industry has exceeded increases in the gold price, which should put some strain on margins. And further, as I say, as a consequence of the dearth of sustaining capital investments and new capital investments, that the real costs in the gold business are understated rather than overstated.
The silver miners have very little profit margins, especially when silver only a couple of weeks ago was around 21 an ounce. I know the earnings for a lot of these silver miners lately has been absolutely horrible, but the gold miners look like they had $300 to $600 an ounce profit margins, or do you think that they're overestimating those margins?
I think that the margins, according to generally accepted accounting principles, are accurate. And I would tell you that the last 2 years have been robust years for the gold mining industry. I merely point out that inflationary pressures are taking place throughout new mine build, but also mine operations. Mines, as an example, are very energy intensive. And the energy price increases that we've experienced in the last 2 years, of course, hit the gold mining industry. The other thing that investors in the gold mining industry need to consider is that there's an age gap in mining, which is to say that skilled miners are looking increasingly like me, which is to say old, fat, bald, past their prime. And the wages that need to be paid to attract new skilled people to the mining industry are higher than they have traditionally been. So investors need to understand that costs are going to rise in the future. That could be taken care of by rising prices. It's just that somebody needs to pay attention to it.
So there's a lack of talented personnel in the mining industry, and salaries are going to have to be higher. But also, Rick, in emerging markets, because these other currencies are weaker against the dollar, you're also seeing for a lot of these producing miners like Newmont Mining, which released their earnings recently, and they said their labor costs are 50% of their input costs. So if they're operating in an emerging market, and a lot of these mines are in developing countries, those labor costs are going to be going up too, to offset, at least partially offset some inflation.
I think you see two things there. If you are operating in a country where you sell your product for US dollars and you pay your inputs in currencies that are depreciating, your margins as a consequence of that widen. What has happened traditionally in, as an example, Africa, is that the skill sets around the labor force were fairly poor, which means despite the low wages, the worker productivity was very poor. We are seeing in the last 3 years, mercifully, at least in West Africa, a rapid increase in the skill sets of wage-based labor in Africa. We are seeing, too, the emergence of an African political class, geologists and engineers, who are every bit as capable as their expat counterparts, but don't have to receive hardship pay to live in the Ivory Coast or Ghana or Congo because they don't see it as a hardship. They already live there. So that is one bright spot around, in particular, West African and Central African, as opposed to South African gold input costs.
So your career, you specialized in financing mines. You've helped build a lot of mines with getting it financed and looking through all the project economics, the feasibility studies, the geology, all the different things that go into that before you actually write checks to the miner or help the miner raise the capital. Are we in an environment where even though the metals prices are high, but because the Fed has raised interest rates, that the cost of capital to build a mine is going to be very, very difficult?
The cost of capital is going up. Ironically, right now, that shoe hasn't dropped because we have to go back in history a little bit. Mine finance capital changed as a consequence of Basel II, where banks' investment in project debt for non-investment grade quality projects became problematic. And the project banks that used to fund mine construction for non-investment grade projects, banks like the Royal Bank of Canada, Barclays Bank, Citibank, banks like that became more or less precluded by the Basel banking accords from participating in project debt. It became very scarce. And a whole bunch of non-bank lenders, including ourselves, of course, at Sprott, but also Orion, Triple Flag, Taurus, a bunch of non-bank lenders came into the non-investment grade space. And the capital availability in the space went from zero to about $15 billion over 10 or 12 years. What's beginning to happen now is that as the yields available on competing products increase, the money that the non-bank lenders need to charge is going up. Similarly, the interest rate on takeout financing, semi-permanent financing, has gone up. And as that has happened, the dividend yields being paid on equity has to go up because the yield that's paid on competing interest products goes up. So what you say with regards to the increased cost of capital in the mining business and other capital-intensive businesses is something that managers and investors need to take note of going forward.
So let's talk about a case study then for this. So even though the gold price is almost at $2,000 an ounce, you're saying that it's going to be difficult for, say, an emerging producer, say, Cisco Mining with the Windfall project in Quebec. And it looks like they have a very good project. Their feasibility study came out, 4 or 5 months ago, I think in November 2022. And it looks like a really high-grade project, long life mine. You're saying even for a really good project like that in Quebec in a safe area, it's going to be very difficult to raise the capital to build a mine?
That's a trick question because in Quebec, you will likely receive provincial assistance in the mining finance package. If the project was outside of Quebec, I would say yes. 10 years ago, the median cost of capital for a non-investment grade construction project with 70% loan to value was a total all-in cost of capital expense of about 15% per annum. That's fallen over 10 years with a declining interest rate and with a proliferation of non-bank lenders down to an expected case of 11 or 12%. I would be very surprised if by the end of 2023 that the interest expectation or the interest needs of lenders isn't back up to the 14 or 15% rate, which is to say 300 or 400 basis points higher than has been the case for the last 15 to 18 months. The differences will come in jurisdictions that regard themselves as pro-mining, Quebec being prominent among that. The connections that the Cisco people have with what I laughingly call Quebec Inc., the Caisse de Dépôt Populaire, and other parastatal arms of the Quebec state are such that I would expect a good project in Quebec that is promulgated by Quebecois, even English-speaking Quebecois, will enjoy an interest rate subsidy. I think that a Cisco will be able to enjoy an interest rate subsidy building in Quebec.
Do you think that a lot of these other potential new mines, are they going to have to go through royalty and streaming companies? Because you talked about how a lot of these banks, for different reasons, will not be lending a lot of the capital unless it's maybe a copper project or something that's ESG, that has an ESG bend on it, because copper is viewed as a necessity, I guess, for electrification and electric vehicles. But do you see the royalty and streaming companies taking advantage of this with limited access to capital, even though metals prices are higher?
I think the streamers will be superb beneficiaries of it. I'm not so sure that, with the exception of very large financing packages, that the royalty companies will necessarily be a beneficiary. But I see the streaming business being able to allocate 10 or $15 billion more in good transactions than would otherwise be the case. What I hope happens, Jason, is that the junk projects, the projects that shouldn't get built, don't get built. There have been, probably a dozen projects built in the last 3 years that never should have progressed past the drawing board. They got financed because they could get financed. And I think that's the wrong way to operate a mining or a finance business.
Do you want to name some of those mines so our listeners know to stay away from them that you think have the most problems?
They've already shown up. People who pay attention know what they were. If you look at the mines that have failed,
is one of them Jared Canyon from First Majestic Silver, or am I thinking of a different one?
Not yet, because there wasn't much debt there. There was equity. What you had at Jarrett Canyon was a management team that had made an absolute fortune buying old, long-of-tooth mines that had been starved of capital. Putting the capital in them that was necessary to resuscitate the mine, and then operating the mine successfully. First Majestic did that twice before, notably, of course, at San Dimas. They tried a hat trick. They tried it at Jarrett Canyon. It's a mine that has had insufficient working capital and sustaining capital reinvestment for 12 years. It's a mine that has lacked for near mine exploration expenditures. The First Majestic guys took it over and have thus far been unsuccessful at making enough changes in the mine through sustaining capital and new exploration expenditure that they could bring the operating cost down. They have made the hard decision, I believe the right decision, to shut the mine down, to save the remaining ounces from being produced at a negative margin. They're proposing now to spend $25 million on near mine exploration and delineation, and make such capital improvements to the mine as are warranted by the results of the exploration before they restart the mine. This is not a mine that suffered as a consequence of a stupid financing package. This is a mine where a management team took a considered risk with regard to their already proven ability to take a large capital-starved mine and return it to profitability, and thus far have failed.
Yeah, it just looks like a money pit. I know the narrative for First Majestic Silver was that they were going to do one country and one product. So they were focusing just on silver mines in Mexico, and then they deviated from that. But over the last, 7 to 9 years, a lot of these primary silver producers have been forced to buy gold mines because the profit margins are just better on gold mines.
I don't think that there was anything quite that cynical taking place with First Majestic. I think that First Majestic had come to believe in their ability to buy very long mines that were regarded by the market as long of tooth, but mines that had in fact been used as cash cows and starved of sustaining capital investments. And First Majestic, I think, believed that they could buy a mine that hadn't produced for others, spend money on it where money had been extracted from it, and return it to profitability. Thus far, the challenge has been too large for them. I don't think that this is a deliberate pivot by First Majestic away from silver to gold. Your point is well taken, however. Most primary silver producers don't make much money at today's silver price. They're competing with sources of supply where the effective cost of producing silver is very low because the mining and processing costs are paid for by the extraction of the main mineral of the mine. Most silver is produced as a byproduct of gold mines, copper mines, lead mines, and zinc mines. And in those circumstances, the byproduct silver cost on a unit of production basis is very, very low, particularly when compared to primary silver miners.
So I want to get your thoughts on the mergers and acquisitions or proposed deals that have occurred in the gold and silver mining space lately. So there's a proposal for Newmont to buy Newcrest. B2 Gold also did an acquisition recently. Hecla bought Alexco, and then Agnico Eagle and Pan American Silver won a bidding war and they bought out Yamana. Do you think any of these deals that you like did you like any of these deals particularly more than the others?
In every case, I think a full price is being paid. I think with regards to the Newmont Newcrest acquisition, that at the very top of the market, if Newmont is able to reduce the general and administrative cost of the combined company, which is to say, if they can lower the G&A relative to AUM and relative to EBIT, it'll be a good transaction. I like some of the growth profile around Newcrest, although I don't see any particular synergies between Newmont and Newcrest. I think this is a circumstance where they hope being larger and more liquid will increase their trading liquidity and lower their cost of capital. And I hope it's a circumstance where they see being able to lower general and administrative costs relative to other things. I have a better feeling about the acquisition, a more bullish feeling about the acquisition by B2, simply because I've looked at the 4 prior acquisitions by B2, acquisitions and dispositions, and I've seen that intelligent acquisitions are part of the DNA of B2. What they're taking on with the acquisition of Sabina, make no mistake, is a challenge. Trying to build and operate a mine in the middle of caribou pasture attached to nothing else is a challenge. But the size of the deposit and the grade of the deposit and the work that McDonald and his team have done, McLeod, I'm sorry, I think bode well for the future. I'm particularly attracted, however, simply to Clive Johnson and his team's ability to buy assets, build assets, and operate assets, which is to say, I trust in the acquirer. The acquisition by Pan American and by Agnico Eagle of the Yamana assets appears to be accretive in every regard. Agnico Eagle gets access to 100% of Malartic, which means that they get to function and focus on a very, very, very large mine. Pan American has more of a challenge, assimilating a bunch of tier 2 mines and one tier 1 mine in their portfolio, and further degrading perhaps their status as a silver producer. They now become a much more gold dominant producer, and I think they have greater implementation challenges. But this is taking place at a price that should be accretive on a per share basis to Pan American shareholders. And Pan American, although they've had some stumbles, also has a track record with regards to acquisition and implementation that bodes well for this acquisition. The acquisition by Hecla of Alexco is, from my point of view, a little more problematic. The Hecla people do have expertise in narrow vein, high grade mining, and this is certainly an example of that. My own personal bias, as you know, Jason, is against small mines. I don't like to take big risks for small rewards. And I'm concerned about the ultimate size in Alexco and its ability to generate returns, particularly if there's an early stage hiccup. So I'm a bit afraid of that transaction.
Yeah, Pan American had a lot of CapEx bills due before that acquisition. So I was actually predicting that they were going to do share dilution. But the way they did the share dilution is they went and bought the producing assets from Yamana, the Cerro Moro mine, and some of the other stuff. So they got some cash flow there for the share dilution. But then they went and sold their stake in Mavericks Metals, the royalty company that they spun off, because they owned a large chunk of that. And I guess that was to raise cash to help fund the rest of the acquisition.
I think that's right. I think that Mavericks wasn't core to the way that they were trying to build the company. You will note, and I will note, that if you're Pan American and if you pay all shares for new acquisition, you suggest that the assets that you're acquiring are more valuable than your shares. One of the reasons that I owned and own Pan American is I was always attracted to the fact that you had two separate 500 million ounce silver assets in Argentina and Guatemala, respectively, that weren't producing, and since they weren't producing, weren't in the value proposition of Pan American. I always believed that by owning Pan American, I had in effect a warrant on 1 billion high-grade ounces of gold. And certainly the acquisition by Pan American of the Yamana assets has diluted my interests in the optionality around 1 billion high-grade ounces of gold that's undeveloped.
Oh, you mean
and I must say I'm a little choked about that.
You said 1 billion ounces ago. You mean silver, right? Because you're referring to a lot.
I'm sorry, Jason. Thank you.
Yeah, you're referring to La Navidad in Argentina. Do you think that's actually that mine's the policy of that province? Because I know we spoke in our last couple interviews about that province and how they wanted some type of extra incentive to approve the mine. And I'm using incentive in air quotes here. Yep. Based on what you told me in the last interview, do you think then that mine's actually going to get approved then?
I think Guatemala will return to production before Argentina, but I do believe that the Argentine mine will be built. It may be built in the 5 to 7 year time frame. In other words, it may be approved in the 5 to 7 year time frame. I was just in Argentina, and I spent a substantial amount of time talking to various people in Argentina, including people in Santa Cruz province, about that mine. And I think that the political structure of that province is changing slowly. I think the difficulty that mine faced is twofold. One, the people that aren't out on the Deseado, the people who aren't immediately impacted by the mine, but rather the richer people who live in the mountains, particularly around the ski resorts, who object to all mining. But the real problem was the caciques, the people who ran the province and were looking for personal benefit from public policy. Let's put it that way charitably. I think what you're seeing now is a circumstance where many Argentines are coming to believe that in order for the country to move forward, that some of the old ways have to change. Change slowly, to be sure, but change. The idea that a cabal of 3 different families could control the province of Santa Cruz, and that in order for progress to be made in the province, that those 3 families need to be taken care of, I think is increasingly becoming a thing of the past.
For our listeners not aware, I think that's the only province in Argentina that's not pro-mining yet. So pretty much all the other ones over the last 7 to 10 years have switched over to pro-mining. There's been a lot of investment from a lot of mining companies for copper mines with gold or silver byproduct into Argentina lately. But that project, the La Navidad mine, is arguably the best undeveloped high-grade silver mine in the world.
I think that's accurate. It would be easy to mine. I've seen it. It literally sticks out of the ground.
And the grades are very, very high, right? It's similar.
Yes,
it's comparable to Mag Silver's grades, I think, at Juanicipio.
I wouldn't want to make that representation across 500 million ounces, but certainly it is one of the 2 best undeveloped mines in the world.
In your opinion, what's the other undeveloped silver mine? That's great.
Well, the one in Guatemala, which is developed but not producing.
Yeah, the Pan American also owns they got from Tahoe, yep. Right? So
correct.
So I want to transition now and ask you about the royalty companies. So the royalty companies, the last 12 months, there's been a lot of mergers and acquisitions. There's not many smaller and medium-sized royalty companies left. Do you think that the industry is going to have to consolidate further because of higher cost of capital, and we're going to need much larger royalty and streaming companies to help finance, because now it's a major normal part of the capital structure for a new mine to go into production and to sell a stream?
Yes, yes, and yes. There was a proliferation of small royalty companies because investors were flocking to them, and royalty companies enjoyed a cost of equity capital that was sub-zero. The consequence of that is that the smaller royalty companies acquired royalties like drunken sailors. paying substantially too much for them. Investors have come to understand that a small royalty company, particularly with a predominance of unproducing royalties with high G&A, becomes a salary machine rather than an investment. The royalty business, like every other aspect of the mining business, needs to consolidate so that general and administrative expense relative to assets under management and relative to free cash flow declines. I think that there is still a lot of room in non-producing royalties, but I think that non-producing royalties either need to be bought by private equity people or people like myself with a long-term time frame, or they need to be an adjunct of the portfolios with companies that have mature enough portfolios, enough free cash flow to amortize G&A. The third thing that you said is that royalties will still be part of the financing stack, both for exploration and development. And while I think that's true, I think that increasingly royalties will play backstage to volumetric production payments, offtake agreements, and streams, where I think that the real heavy lifting in mine finance and mine acquisition will take place.
Well, I mean, most of these companies, the royalty and streaming companies, especially if they get to the scale of like Mavericks Metals or larger, they can do streams. So if you're a smaller company, yes, you can't do a stream without taking out a bunch of debt or massively diluting the shareholders. But once you get to a certain scale, say Mavericks Metals or larger in market cap, at least a couple $100 billion, you can start to do sizable streams.
It's important to note, as you say, that with size comes flexibility. If an investment bank or a specialty lender like Sprott is putting together production finance, if streaming is the best source of quasi-capital in the equity stack, the financier, the non-bank entity, the Orions of the world or the Sprotts of the world will approach companies as streaming partners that are at least at the level of, Mavericks / Triple Flag on up. It's easier to put together a financing package where a $150 million stream can be provided by one or two entities, rather than cobble together 7 or 8 bids from smaller royalty companies. So what you say is very true in every regard, Jason.
So you're in favor then of these acquisitions that Triple Flag bought Mavericks and Sandstorm Gold bought Nomad. You think then on paper, then over the next 3, 4, 5, 6 years, these deals are all going to work out and they're going to make much more efficient quality companies with cash flow diversification, profit margins, and then they can go and handle these large streaming packages to build new mines?
I'm not suggesting that either of those acquisitions took place at attractive multiples for the acquirer. I am suggesting that larger is better in the royalty and streaming space, particularly where, in the case as an example of Triple Flag, substantial reductions were made in general and administrative expense.
But these combined companies look a lot safer, though, on paper, though, especially as these new royalties and streams that are under construction get built out. I know Sandstorm Gold has the Greenstone gold stream on the Greenstone mine in Canada that's under construction from Equinox Gold. So that mine's almost done. It's over 70% done with construction. So these things, like on paper, they look really, really good over the next couple of years.
I think that's completely accurate. I would note too the Turkish assets of Sandstorm.
Oh, yeah. You have the Hotman mine finally, which is under construction now. I think they're getting local bank debt. So you have a lot of near-term growth. These assets are not priced in. The market's not pricing in the cash flow that's going to be online in the next 12 months from the Greenstone gold stream in Canada. And it's not pricing in at all anything from Mongolia or from Turkey.
Agreed.
I want to get your thoughts now on uranium. So in this environment where energy prices are falling, do you think some of these smarter governments are actually still looking to build new nuclear power plants?
I don't have to think. You just look at the statistics. 3 things are happening, I think. One, plants that were slated for shutdown aren't being shut down. Existing plants that were shut in particularly in Japan, are being restarted. But importantly, looking forward, the rush to build new plants, particularly in places like China, Korea, the United Arab Emirates, and Saudi Arabia, new plant construction is rampant. All of this is beneficial for the uranium business. This isn't a matter of my personal conjecture, though, Jason. This is a matter of public record.
Are the low-cost uranium producers, do they have good profit margins now, or do you think that the uranium prices, the spot price, is going to have to be a lot higher for them to make good profits?
Two different questions. If you are one of the low-cost producers, in particular, if you're Kazatomprom, China General Nuclear, or Cameco in Kazakhstan, there's a lot of money to be made at $50 uranium. There's more money to be made at the prices that companies are locking in the term market today, which is to say 55 to 57. The profit margins that will be enjoyed by incumbent producers are very different than the profit margins, fully loaded profit margins, including cost of capital and amortization of capital, that face new mine construction. It has been estimated that on a global basis, which is to say, including all of the inefficient producers, that the all-in, fully loaded cost to produce a pound of uranium worldwide now is between $55 and $60 a pound. If you add back unsuccessful efforts, if you add back cost of capital, and if you add social rents. So the industry as a whole makes the stuff for between 55 and 60 and sells it for 50, which means that the aggregate industry profit margins, not AISC, but total costs, are still negative.
It was even worse, though, during the bear market post-Fukushima for 5, 6, 7 years. So while Kazatomprom was increasing production and loading the market, then you had all these Japanese nuclear power plants, the energy companies, they were reselling their uranium supply back into the market as they were shutting down nuclear power plants. So it was even worse than that, the negative margins you just described for years, post-Fukushima.
Much worse. And mercifully, some parts of the uranium business, Cameco and Kazatomprom, came to the conclusion that it made no sense to produce pounds to sell them at a loss when that market was unsustainable. They shut in production, saved the pounds for the shareholders. A combination of that and the fact that my former employer, Sprott, bought 55 million pounds of uranium, I think has straightened out the spot market.
Yeah, I see where, especially with higher costs for mining, all these costs are up over the last 2, 3, 4, 5 years for mining. So cost of capital's up, labor costs in emerging markets, energy costs for diesel, chemicals, electricity, materials cost to build. And all these costs, Rick, they might have in the short term, especially energy costs, fallen a little bit, but they're still trending higher over the long term.
What you say, again, Jason, is borne out by statistics. Just as I said that the estimate for the fully loaded cost of existing production was between $55 and $60 a pound, it is estimated that the incentive price for new construction, including in Kazakhstan and including NextGen, is $75 a pound. Now, that doesn't mean that some new builds wouldn't be economic at $35 or $40 a pound. What it means is that the incentive price for the length and breadth of the uranium business for companies in feasibility and pre-feasibility is $75 a pound rather than $60 a pound, which points precisely to the inflation that you describe in the cost of capital, in the cost of consumables, in the cost of cement, in the cost of steel, and in the cost of labor.
Yeah, I see all these costs trending higher. So when the natural gas price right now for the U.S. natural gas price, U.S. and Canadian producers is around 2, that looks to me like a lot of supply is going to come offline in the next quarter or two. And a lot of these natural gas producers are just going to turn off supply. They're running at losses right now. I don't know very few natural gas producers that can actually produce at these costs.
Again, a wonderful point. 3 things will happen. One, the very low prices will continue to encourage the consumption of natural gas and the development of liquefied natural gas export facilities to take advantage between the global price of liquefied natural gas and the American price. That's the first thing. The second thing is that solvent producers will shut in production, saving production to sell at a later date. I'm doing that with some of my own personal production. I have no interest in selling gas at $2 that a year from now I'll be able to sell at $5.50 or $6. The third thing that's happening is that the natural gas industry is deferring new project drilling and sustaining capital investment. Gas production and oil production is fairly consistently tied to sustaining capital investment. And to the extent that you don't make sustaining capital investments in 2023, you don't produce well in 2024 and 2025. There's an iron law that you got to put capital in to get production out. And so for those three reasons, I think that you'll see markets work. I think that you'll see that the cure for low natural gas prices is low natural gas prices, just the way that the cure for the high natural gas prices of 18 months ago was high natural gas prices. Markets work, but they're messy.
Yeah, especially with governments, politicians, bureaucrats, regulators trying to force ESG policies. But there's tons of oil and natural gas drilling bans in many countries. And then a lot of these other countries, even though they have oil and natural gas drilling bans, the politicians are actually announcing in the last couple of months that they're approving new liquefied natural gas import facilities. So like you said, at these prices, the producers, most of them are not making any money. But at these cheap natural gas prices, if you're a utility, an electrical utility, you're going to say, I'm not going to buy coal. I'm going to go buy more natural gas for electricity generation at these cheap prices. I'm going to lock in as much as I can.
Or if you're Cheniere and you can buy natural gas for $3 a million BTU in the US and sell it for $9 or $10 a million BTU in Japan or Europe.
Oh, they're booking long-term deals hand over fist. They just did one in the last 4 or 5 months with one of China's national oil companies. They just did one for the British Columbia, Vancouver liquefied natural gas export facility with Tourmaline. So Cheniere's just booking deals like crazy.
Truly a superior business, justifying what you say.
Yeah, long-term, it looks really good. And so if that stock were to crash, that would be a potentially good buying point there from a contrarian standpoint.
You know, I'm already reasonably long natural gas stocks, and I will be increasing my personal position in them.
So recently we've had comments come out about the Permian Basin that the oil production growth from the Permian Basin, which is the US's best supply driver for production increases over the last 10 years, is starting to peter out. There's experts that are saying it has already peaked. The Pioneer Natural Resources CEO and other petroleum geologists have said 5 years max for the Permian Basin. Where do you think the oil production growth is going to come from globally then if the Permian Basin does peak and the production starts to sputter out?
Well, globally, we have no problem. In the United States, we have some problems. It would be very easy to increase conventional production in Canada, and easier yet to increase heavy oil production in Canada. If the United States was concerned about oil supply, Biden could approve the debottlenecking of the Keystone Pipeline and move heavy oil, which is an oversupply in Canada, to heavy oil refining capacity, which is underserved in the U.S. Gulf Coast. There isn't a problem with regards to oil supply. There's a problem with regards to politics and a problem with regards to sustaining capital. We talked about sustaining capital investments as it relates to the gas producers, but it's estimated right now that on a global basis, despite high cash flows in the oil and gas business, that the oil industry itself is underinvesting in sustaining capital to the extent of $1 billion a day, $365 billion a year. This is happening for fairly obvious reasons. The political class, while they have told the oil companies to keep gasoline prices low, have also told them that they're going to put them out of business in 2030 or 2035. The oil companies are taking the politicians at their word, and they're decapitalizing the oil and gas business, which reduces their ability to produce oil and gas 2 or 3 years out. We have access, lots of access to geological supplies of oil. We have that access in friendly countries like Canada and unfriendly countries like Venezuela and Russia. But make no mistake, we need to drill to get that oil. It is also true that the incredible advances in production that we've enjoyed in the Permian Basin as a consequence of political stability, low cost of capital, and exploration and production technology has begun to exist our supply of tier 1 locations. We've simply drilled most of them. If technology improves, if exploration continues, it may be that we can develop more tier 1 locations, A quality locations. But we have done an amazing job of drilling our inventory of tier one locations, and we now need to move to tier two locations in the Permian Basin unless technology and exploration improve.
Well, I think even the Saudis with Aramco, they've replaced a lot of their production at Gawar, which is their major onshore field that's been going for over 100 years. They've been replacing more and more of it with deep water offshore wells for oil and natural gas. So that's higher cost stuff. So I think that's a trend that's kind of unavoidable, is a lot of the easy stuff that was onshore, low cost. The wells were gushers. Those wells are being replaced with much higher cost production, either enhanced oil recovery or deep water.
What you say is true. Gawar, of course, is a gem. And the Saudis have understood that they were pulling Gawar too hard. It's the world's largest water flood. And one thing that happens in a water flood is that if you pull it too hard, the water underneath the oil acts as a drive. And if you pull it too hard, the water cones or it breaks through the oil and it segregates what was once a giant efficient reservoir into 10 or 12 inefficient reservoirs. To their credit, the analysts, the engineers at Saudi Aramco made the politicians in Saudi Arabia understand that the Gawar could be a gift that kept on giving, but they needed to reinvest in the resource rather than merely harvest it. And there needed to be a hiatus in the production growth at Gawar so that the water flood and extraction could be re-engineered. I think the Saudis have done an amazing job of re-engineering Gawar, and I think that Gawar will produce, albeit less efficiently, for a very long time.
So this oil production growth you're talking about potentially out of Canada, and I think Suncor and Canadian Natural Resources are consolidating. They're buying up a lot of assets lately. Do you think then that's going to be low-cost production? Is that $40, $50 a barrel oil sands that could be converted to heavy sour crude?
I don't think that oil sands production at today's energy prices will be as low cost or as high quality as Permian production. Once you get this oil, you have to upgrade it. The game changer, and I don't think it'll happen, it's just technically feasible, would be if you built nuclear power plants in the Athabasca. If you used the waste heat from a conventional nuclear power plant, and rather than venting it into the atmosphere, used it to pump steam into the subsurface, and you used low cost, clean electrical energy from nuclear power plants, you could bring down the unit cost of the oil sands production through huff and puff methods, through multilateral completions rather than through mining. And you could substantially reduce the unit cost of heavy oil in Canada. I don't think that'll happen because of the political realities of the oil and gas business in Canada and the hostility of the federal government of Canada to producing hydrocarbons. But technically, it's very, very feasible.
Yeah, I've actually never heard that before. I know Canada is not exactly anti-nuclear, but I never heard anyone proposing to build a nuclear power plant around there and use the steam as. So it sounds really efficient, but unfortunately, common sense ideas that sound like they're going to be efficient, the politicians, especially the ESG crowd, just won't do it.
Accurate, sadly.
Well, as we wrap up here, I have a couple more questions on copper. Do you think we're starting to actually see a new deal was just announced this week? Lundin Mining just bought the Caserones copper mine in Chile. Do you expect more mergers and acquisitions in the copper space? Because it looks like a lot of these really old copper mines that have been running for decades, they're getting really long in the tooth and the costs are going to go up. The grades are falling. Do you expect that there needs to be a lot of new copper mines brought online to replace the old ones soon?
Again, yes, yes, and yes, Jason. If you look at the copper mines that produce most of the copper in the world, I'm a metaphor for them. Old and past my prime. Bingham Canyon, 155, 160 years of age. Chuquicamata, 120 years of age. Teniente, 70 years of age. Escondida, 45 years of age. Grasberg, 60 years of age. These mines are past their prime and long of tooth. Have we had some new ones? Sure. Cobre Panama, Kamoa-Kakula, absolutely. But the truth is that we're approaching a supply cliff. And we're approaching a supply cliff at the same time that demand for copper is taking off. Jason, it isn't just electric vehicles. One billion people on Earth have no access to electricity. 2 billion people on Earth have access to unaffordable or intermittent electricity. The increase in material living standards of humankind and the energy density that's required to deliver that guarantee that demand for copper grows at the same time that supply of copper is shrinking. Do we need to build more mines? Yes. Do we need to increase the budgets for copper exploration? Yes. Do incumbent copper producers need to buy other people's mines to maintain their production? Yes. The acquisition of Caserones by Lundin is a really ballsy move. The median grade of Caserones is 0.36. The median production grade of copper mines worldwide is 0.5. And the historic median production grades of copper mines worldwide is 1%, which is to say that Caserones produces at a third the median grade of historic copper mines. But Lundin is able to upsize Caserones so that it produces at their nameplate capacity, 150,000 tons a day, rather than 100 tons a day. 100,000 tons a day. And particularly if Lundin is right about the direction of copper prices, this will be a wonderful acquisition. But this is not a riskless acquisition.
Well, Lundin's known for taking risks, though. I mean, they were buying, they bought 50% of the Tengufu Gorome project in the Democratic Republic of Congo, and they did really well on that. So they were buying it when everyone else said, don't buy it. The mine's going to go bankrupt. Lundin's going to go bankrupt. I was buying shares, I think, at like 30 cents a share back in 2008, 2009. And 18 months later, I sold my shares for $5. So they're known for risk, calculated risk taking.
The biography of Adolf Lundin was titled "No Guts, No Glory." I'm not saying it's a bad acquisition. I'm saying it's a ballsy acquisition.
Yeah, and didn't Lucas before he passed away, he was driving motorcycles and race cars.
Yep. I'm not saying it's a bad acquisition. I'm just saying it's a ballsy acquisition.
Yeah, they take calculated risks, and sometimes they work out, and sometimes they don't. But I mean, like, you look at super high grade copper mines, Rick, like Oyo Tolgoi, and look at all the delays, the construction delays, the fights with the government. So even though it's arguably one of the best copper projects in the world, the thing has been it's cost billions of dollars more, and it almost put Turquoise Hill into bankruptcy.
The Lundin family has an admirable history of being willing to invest sustaining capital in mines. Building mines and renovating mines. And my 40-year history with the Lundin family tells me that they will be a success at Caserones too. I had the good fortune to be around what was in effect the discovery of Caserones by Ross Beatty in Lumina. And I always liked the size of the deposit. And I always liked the probability that drilling that deposit off on closer centers would lead to higher grade reconciliation. I've always believed that the mined grade of that resource would actually exceed the feasibility grade of that resource. And I hope that the Lundins are able to prove that supposition to be true.
When you went to Argentina, did you also have a chance to visit the Mara project that it looks like, not Newmont Mining, that Glencore and some of the other larger miners are going to be putting into production the next couple of years?
I'm delighted to say that I didn't visit any mining project or any oil and gas project. My primary reason to be in Argentina was to go on a very long vacation with my wife, which I did and which I enjoyed. I was able, as a consequence of being in Argentina, to be able to question many powerful and influential people in the country about, among other things, mining, oil and gas, and Argentine politics as they related to the economy of Argentina. But I did not visit any mines.
Okay, fair enough. Well, glad you got a vacation, and you are semi-retired, right? So
I failed retirement, Jason. Notice an old retired guy here in a shirt and tie, pardon me.
Well, this interview is only audio, but I appreciate you dressing up. As we wrap up the interview here, can you tell my listeners about your upcoming conference in Florida?
I look forward to that, Jason. Thank you for the opportunity. Many of your listeners know that I've been putting on natural resource investment conferences for 30 years now. This year's conference will be in Boca Raton, Florida, as a consequence of the fact that that's where my attendees wanted the conference to be. The reasons to attend the conference are, first of all, a 30-year track record. We've been doing it for a long time. We know how to do it. We bring the greatest gurus, the big picture thinkers that you can, not the gurus that you hear on CNN or BBC or CBC, but rather the Bill Bonners, the Nomi Prins, the Daniela DiMartino Booths, and the Jim Rickards of the world. A different worldview, but a worldview that many of us hold and isn't represented in popular media. We also bring the best analysts and portfolio managers in the business, people that knew how to spell uranium 6 years ago when the Johnny-come-latelys didn't, to tell you how, if you agree with this worldview, you should implement it in your own portfolio. More importantly than that, Jason, we've had a feature for 30 years called The Living Legends, where we assemble a small group of entrepreneurs who have each individually built multi-billion-dollar mining companies from scratch, where they tell you how the lessons that they learned building these multi-billion-dollar mining companies made them better investors and can make you a better investor too. And finally, every exhibitor at our conference is regarded as content too, not merely as advertisers. To be an exhibitor at our conference, your stock has to be owned in our accounts or in accounts that we manage. That doesn't mean that every stock that we buy goes up, but what it does mean is that every exhibitor that exhibits for us is well enough known that we own them. Finally, Jason, unlike any other investment conference I know, if you as an attendee don't believe that you have gotten your money's worth out of attending the conference, email me and I'll return your money. An absolutely ironclad money-back guarantee. I've been making this guarantee for 30 years. I've had to refund less than 0.5% of the tuition fees I've charged over 30 years. But this is an ironclad guarantee that conveys no financial risk to you whatsoever.
And you have really big names speaking at the conference. It's impressive.
It's going to be a really fun conference, Jason. I look forward, hopefully, to seeing you there.
We'll see if I can get down to Florida. I may be taking some time off. I kind of need a shoulder surgery. Well, Rick, you are a wealth of information on natural resources. I want to thank you again so much for your time today. My listeners want to take a look at Rule Investment Media, or they want some portfolio grades on some of their mining stocks. I'll attach links to that too.
Yeah, Jason, that's all there. Any of your attendees who care what I think about their natural portfolios can find out. If they go to Rule Investment Media or click on your link and list their natural resource portfolios, please no crypto, please no tech stocks, please no pot stocks. I'll review the natural resource stocks, 1 to 10, 1 being best, 10 being worst, and I'll comment on individual issues where I think my comments might have value.